some words of wisdom from a world-renowned investor, Warren Buffett, in which he's talking about the subject that shareholder gains must match business gains, in which he says, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn. And when the stock temporarily overperforms or underperforms the business, a limited number of shareholders, either sellers or buyers, receive outsized benefits at the expense of those they trade with. Over time, the aggregate gains made by shareholders must of necessity match the business gains of the company. And this principle is often forgotten by investors. Now that we have Warren Buffett's take on the subject matter, let's get into Chapter 2's Rational Exuberance, in which it starts with common sense saying that cumulative long-term returns earned by American businesses must match the cumulative returns earned by the stock market. Now, you might not believe that, but we have Exhibit 2.1 from the book, in which we have investment return versus market return, with the growth of $1 over the course of 1900 to 2016. And here we have investment return, which is earnings growth plus yield, coming out to 9%, where because we have the 4.4% dividend yield plus the 4.6% earnings growth, and then we have the market return, which includes speculative return, coming to an average of 9.5% over this time. But you might say, 9.5% does not equal 9%. And that's correct. The 0.5% difference is what you would call a speculative return. And that allows us to transition into speculative return, in which it also ties into the increase or decrease of price to earnings ratio. Because the PE ratio is a measure of how much you're willing to pay for each dollar of earnings, and it's impacted by investor confidence. If the future seems grim, investors would pay less for earnings because they don't expect the growth to be as good. And when they're optimistic, they're expecting more earnings to be coming in, so they're willing to pay more. In other words, if investors are greedy or optimistic, the PE ratio is going to be high or very high. And if they are hopeful, the PE ratio will be moderate to high. And if they are fearful, PE ratio will be very low to moderate. Speculative return reflects the swing in the emotion of investors. So maybe they have a very greedy or optimistic idea for this company, and they think that earnings are going to skyrocket, and that bad news will come out, and it'll cause it to go down to fearful that it won't work out. The swing in emotions is what causes this speculative return. So let's get back into investment return versus market return. And we'll take another look at our Exhibit 2.1. And the total market return, as you can see, is very close to investment return on stocks. The divergences between both values are very short, whether it's the investment return going notably higher or lower than the market return, or vice versa, the market return being notably higher or lower than the investment return. They eventually start closing up and going towards each other. And the power of compounding returns, in which each $1 invested in 1900 with 9.5% would equate to $43,650 by 2015. While only a few of us live to be 116 years old, our descendants, on the other hand, as was the case with the Gottschalk's family, will enjoy the power of compounding returns. This is the ultimate winner's game, to stay in the game and keep your money in the game. Also, we have reversion to the mean, because sometimes stock market returns diverges drastically compared to the business fundamentals, as we saw in the late 1920s, the early 70s, the late 90s, and maybe even today, depending on when you view this video. But it's only a matter of time until it returns to the long-term norm. And the reversion or regression to the mean, the RTM, is the tendency of stock prices to move towards the average price over time. It doesn't matter if the value of the stock drops or rises drastically, because the market eventually returns to fundamentals. Rational exuberance is the other side of the coin, in which stock returns deviate drastically from the long-term norm. We often forget why annual stock returns are so volatile. So why is this the case? Because rarely is it because of dividends and earnings growth going drastically higher. Rather, it's because investing is being driven by emotions, as is being reflected on the changing PE ratio over time. In regards to rational exuberance, a very common error investors believe is that they can predict future returns based on past performance. And to understand why this intuition is wrong, let's look at the words scribed by John Maynard Keynes, a British economist 81 years ago, in which he says it is dangerous to apply to the future inductive arguments based on past experience unless one can distinguish the broad reasons why past experience was what it was. And Keynes helps us understand that long-term expectation for stocks is a combination of enterprise plus speculation. None is not mutually exclusive of the other when it comes to investing in stocks. Let's go deeper into the dual nature of stock market returns, because the stock market returns are divided into two parts. One being the enterprise, which is a forecasting investment return over the lifetime of a stock, and the second one being speculation, forecasting the psychology of investors slash the impact of the difference in the price to earnings ratio. To better go into this duality, we have stock return by decade, in which we'll start with Exhibit 2.2, total stock returns by the decade, 1900 to 2016, percent annually. And we'll start with the investment return as opposed to the speculative return, and we'll start with our investment return, beginning with the dividends. They were positively contributes to a total return for each decade that we looked at, and they averaged around 4-ish%. As for earnings growth, it was positive in every decade except during the Great Depression, and it was greater than 9% in several decades, and is usually around the 4 to 7% range, with 4.6% average per year being the case. Total investment return, remember, is dividend yield plus investment growth from the earnings growth. And decade-long total investment returns are steady at a range of 8 to 13%, and they average around 9%. Now we can enter into speculative return, in which we notice it is inconsistent. It is very unlike the dividends and earnings growth that we saw previously. It has wild variations. So every decade with negative speculative return is immediately followed by a positively correlative amount. For example, as we see with the 1910s to the 1920s, which is right over here, it has negative 3.4 going to 3.3 in the next decade. Then with the 1940s to 1950s, we have negative 6.3 going to 9.3 right over here. And finally, the 1970s, we have negative 7.5 going to 7.7 in the 1980s. The RTM pattern here is that low performance is followed by a period of recovery. Speaking of rational exuberance, let's talk about a very prevalent example in which we have the dot-com era. With the return to sanity, we will be talking about in April 1999, the PE ratio rising to 34 times earnings. And it was followed, as we know, by a huge drop in stock market prices. Now, the point of this is who knows what the next dot-com bubble will be. However, we should always be paying attention to what the actual earnings are and whether or not what we're paying is justified for the cool, new, exciting opportunities that are being brought to us. At that time, it was the internet, but who knows in our future, in our lifetimes, what that's going to be as the new exciting thing for our investment careers. And we have combining investment return and speculative return, total stock market returns. Wild fluctuations in speculative return over the decades has no impact on the long term. We have an average annual total return equaling 9% from the enterprise with the dividend and earnings, plus about 0.5% speculation, which gives an annual return of about 9.5%. Ultimately, the emotions of investors has little effect on stock returns, and investment returns are ultimately